So I'm pleased to introduce Jerry McDonald, the moderator from Causeway Capital of the consultant panel. Just one takeaway. So I could have come up here and hugged everybody after that first panel simply because I really think I know a lot of you in the audience here. There are some spectacular sales and marketing professionals. I always look at it though, we always can learn something, we always can get better, right? And so I thought some of the comments that they made about preparation, explaining the differentiated sources of return, covering a lot of the basic stuff offline, if you will, it's always just such a great reminder, right, on how you can differentiate your strategy. But I think we also saw on that RA panel just how little time they have to meet with sales and marketing professionals or portfolio managers. And so how can we better approach them with better preparedness, better content to sort of take that off the table. So hopefully for you guys, you felt the same way. That was really, for me, incredibly helpful. So thanks to the RA panel and Chris O'Grady. Jerry, I'll let you take it from here with your consultant panel.
Great. Thanks, Guy. Excuse me. My name is Jerry McDonald, and I'm with Causeway Capital. And I'm pleased to have 4 wonderful resources and representatives of the investment consulting community. We have Maureen Austin from Cambridge Associates, Joe Tiber from Tiber Kosmala. We have John Thompson from Aon, and we have Rick Lake from Lake Partners at the end. So thanks everybody for joining. I think a big thank you to Dakota, Guy, Chris, Dan, DiDomenico, because these are pretty important, and as somebody that always sits out in the audience, I try to find little tidbits to help. The consultant, for me, community, it's a labyrinth, as most of you do know, and there's a lot of moving parts. There's a lot of moving chairs and seats, and the clients are shifting. So if you have Sales Navigator on LinkedIn, you'll see all the different notifications. But it's important. So there's this theme of best practices that it sounds cliche, but it's actually really important, I think. And I hope over the next 40 minutes or so, we're going to hopefully spark some conversation and maybe some thoughts about how a community from sales, business development, consultant relations interacts better with the consulting community. And I think hearing some current thinking, their insights about how they approach the business and their clients, and how do we interact with the community, and then also more topical things, investment themes and whatnot. Hopefully it helps deliver a few more ideas out there today. So that said, I'm going to be quiet very, very soon. I did some research. This is the first time I'm moderating a panel, by the way. So I did some research on best practices, and there's so much out there, and it does seem cliche, but I did stumble upon some bizarre experiences from sales professionals, consultant relations, and I quickly dismissed it because they sounded ridiculous. But the more I thought about it, it was horrifying that some of it did relate to some of my experiences. So there were three examples that I'm going to share with you, and just by a show of hands, they could be remotely connected to you, but I'll throw them out there. I want to make sure I get them right because they are bizarre. All right, by show of hands, how many of you or us have been asked to leave a meeting? And not lead, but lead. You're dismissed from a meeting. Okay, thank you. Second one. How many of us have been in a meeting and you get almost all the way through and you realize that the person sitting across from you may not actually work for the firm that you thought that you were presenting to? No one. All right, the last one is, by show of hands, how many of us have had a standing ovation after our finals presentation? So they sound goofy, and I will say 1.5 of those are actually relevant to me. I won't tell you which ones. Not the standing ovation. But there are elements of it that do represent kind of what are the characteristics and the results that lead to a horrifying meeting or a quote-unquote great meeting. So I thought with that, I would ask a rapid-fire question to the panel first. And it's kind of a gut reaction. Don't think about it too much. don't use any names, especially not Causeway, please. But worst investment manager presentation and why? We'll start with Maureen.
I don't think I've had one yet. I don't. I guess the only thing I would say is don't dismiss anyone in the meeting that's asking a question as if they're, and pretend that they're irrelevant to the conversation.
That makes sense.
Well, I would say, well, first off, qualifier, I'm pinch hitting for my partner, Phil Kosmala, and he would have a lot of examples of really bad meetings, I think, dating from his days at the SEC as an examiner, just FYI. But I'd say, yeah, bad meetings. No meeting is really, really a bad meeting. There are dry meetings, boring meetings. I think the meetings that probably maybe get under the skin a little bit or test the patience a little bit would be meetings that there's a lot of arrogance, or that person is the smartest person in the room. Just ask him or her, he'll tell you. Those sorts of meetings, I guess, are least desirable.
Is there a time of day or part of the week that you prefer to do meetings that would make it worse than having a productive?
Well, my favorite, Friday, 4:30 in the afternoon, certainly. But no, I mean,
Right.
round the clock.
John?
I've been pretty fortunate too. I haven't had too many really bad meetings, but I can't think of one, and it really was about arrogance. The guy just had no clue. And I think it was just him. I took the meeting and never heard of the firm before, and I think I know why they aren't well known. But it was really just arrogance, but that's it. But otherwise, I've had thousands of meetings in my career, and they've all been pretty good. So
That's good to hear. That's high praise, I think, for the community. Rick, we've had a quick conversation, and you have an interesting three-part portion of this, and you want to tell what you call this phrase?
Yeah, well, before we go into the three-part discussion, I actually have two astonishingly bad manager meetings from my career, and my colleagues apparently have been relieved of any of these. But one of them is when a manager came to our office, one we were keenly interested in, and he said, I would like to quantitatively prove why our strategy will not work. And I've never had a manager do this. And this was a quantitative fellow who was very enthusiastic about proving that he was right. And he sat down with us and proved why his strategy wouldn't work from a quantitative point of view based on market conditions, and it wouldn't work for the next 2 to 3 years. And he was actually absolutely correct, and we took his advice to heart. And it was very helpful. So from us, it was actually rather, from our point of view, it was informative. From his point of view, it was unfortunately too effective relative to what he was communicating. So I think it was a bad meeting for that manager. The other bad meeting was actually an eye-opener, and in retrospect, perhaps a bit humorous. We were referred in our hedge fund research to a fascinating manager who had a background with the CIA. And he was an expert in international intelligence. And he was applying his international intelligence skills to a very arcane portfolio of microcap stocks. And we had him on the phone for a bit. And we finally said, well, this is interesting. Is there a way we can talk further? Can we meet in person? He said, no, I can't meet with you in person. We said, well, where's your office? He said, I can't tell you that. It's secret, it's classified. And we said, well, you know, the rules of the CIA are a bit different in due diligence, and there has to be a bit, some disclosure going on. And he said, absolutely not. My office location will remain secret in perpetuity. And so maybe that wasn't bad, but it was truly astonishing. And it was very helpful to have that information up front.
I'll add that to my list.
Yeah.
Yeah.
But the other thing you asked was the three-part. And thinking about this context in our session, and I thought it would be helpful at some point, we can do this now or later, would be to go through the good, the bad, and the dangerous way to speak to people like us here in the panel as a professional introducing strategies to people on the consultant side or the allocation side. Good, the bad, and the dangerous.
Maybe we'll expand on that in a second. As you talk about kind of the good, the bad, and the dangerous, and we're going to touch on all that. Maureen, what are some examples of kind of the must-haves that you need to walk away from a meeting and walk away saying that was a good use of my time, that was valuable, and you'll even communicate to other colleagues?
That's a great question. And I think the panelists before us touched on a lot of this. And just to give you a little background, I'm an investment director, so I work with wealthy families. We also have endowment and foundation and pension practices. So investment directors might give you a slightly different answer based on their client needs. But generally speaking, knowing what your investment strategy is important. I know that sounds cliche, but really nailing that and believing in it and articulating why that strategy works for you and what your competitive advantage is in that. Understanding how that plays into the broader market. Your organization, a structure and alignment is very important to us at Cambridge. We want to know if you have skin in the game, if the people that are on the team, if the chemistry is working well. And I think lastly, really understanding the questions we're asking and really addressing and answering those questions. I did reference earlier, you know, the bad meetings we have is when you ask a question and the investment manager sort of dismisses it as irrelevant. It may not seem relevant to you, but it is relevant to us and we're asking it for a particular reason.
That's a good answer. Joe, what would you add to that? And I would ask, maybe if you could address who should be in those meetings?
Who should be in those meetings? Well, I guess I'd start maybe just building on what Maureen said. I think we really look to walk away with a very high level of conviction in the organization and the team also. The optics that the organization and the team project, particularly in a case where you're considering putting that team, that organization in front of your end client, which many times are very sophisticated investment people themselves, are very important. So organizational optics, team optics, I think is huge. I think the last panel touched quite a lot on just key differentiators in terms of the investment process or the investment edge, I guess you'd say. And then also maybe the when it works, when it doesn't work, kind of the static or factor exposure biases maybe baked into the process, a real sound comprehension of that. I'd add that as well.
And John, you work with a massive organization as well, and there's many different business channels. So there's all kinds of ways to take meetings or not take a meeting. There's many different individuals at Aon. Folks sitting out there, what is the best way to navigate to get in front of you? And what do you look for in those meetings? Why would you take a meeting?
Yeah, I'm usually looking to understand what your value add is first. That's the most important thing for any manager, particularly a new manager. If I don't know you, what's your value add and what are you bringing to the table to help our investors? That's really the bottom line. So that's what I'm looking for. Navigating a large organization like Aon, that is true. We are broken down into different practices. So we have private DB, public DB, DC, endowment and foundation, and then wealth management or financial intermediaries, which is where I fall. We all have unique propositions. We all follow the same investment guidelines set down by our investment committee. Our investment committee consists of people from those different practices, which is very good. But we all are going to have a little bit of a difference in why we're taking the meeting. First off, getting onto our buy list, that is a little bit different than probably meeting with myself or one of my other colleagues who are considered field consultants, right? Getting in front of those manager researchers are the people you first really want to get in front of at Aon, because they are the ones, when I need a manager for a particular mandate, I'm going to that team. And furthermore, that team is broken up into 5 different groups. So you have traditional equity, traditional fixed income, private equity, real estate, and liquid alternatives, or what you might consider hedge funds. And each of those groups are obviously specialized, but that's great because we have over 80 researchers. I can tap that group to really get a good idea and good insight into the value add that I need to get into the portfolios that we're building for our clients. So first step I would say is try and get in front of those manager researchers first. Now, me personally, it's a little bit different because I'm going to have a few different mandates than perhaps what the institutional space is seeing. So I may need a manager for preferreds. We may not use a lot of preferreds in a traditional DB plan. So that's something where you might want to reach me if you have a new idea on income. Dividend income strategies, that's probably going to come more from my group because people in the wealth management industry want more income right now. So these are the type of multi-asset solutions we're creating. So if it's a little bit different and retail oriented, you might want to come to me. If you really feel that your value add is with the endowment and foundation world, then you probably want to get in front of Heather Myers, who leads that practice at Aon. So it's really know your clients, KYC, getting to know us, who we are, and how we fit within the organization. And there are a lot of friendly people at Aon, myself included. So if you want to start with somebody, just pick up the phone and ask and see who you think you should get in front of. I'm usually open to giving you names and directions on how to do that.
Thank you. Rick, so this topic of the dangerous.
Yes.
You want to maybe talk a little bit about that and how that relates to when managers come in to, you take a meeting with them, and what do you mean by dangerous?
What do I mean by dangerous? Well, it's interesting. Why don't I start out with what do I mean by good? And
Better yet.
The dangerous will be apparent. So Chris O'Grady, who introduced all of us earlier, once told me his job is to be a research concierge. And it was the first time I heard that phrase, but it was totally on point. So in effect, the people in the audience are here to help those of us up here get their research job done by bringing your resources to bear on your strategy to us as quickly as possible. So let me give you a case study of this being done well. So this wasn't too long ago, but we had done our research at our firm and had picked out a specific alternative strategy that we wanted to make an allocation to. And there weren't that many managers in this niche, and we also wanted to be able to make the allocation not just on the private placement side, but on the 40-Act side. So this narrows down the group even more. So I'm at a conference, I hear one of our candidate managers speaking, I leave the conference and I immediately call the institutional representative group. And I said, I'd like to set up a call and find out some more about a number of these strategies, particularly this one. I had known this institutional rep for quite some time. He felt very comfortable with me. He said, look, I'm taking all the grandparents away on a family trip. Normally a comment, probably not good when you're talking to someone like me, but if you consider someone like us to be an old friend, that's fine. He said, first thing Monday morning, you'll hear back from us. At 9:05 Monday morning, and I normally don't have the time to deal with business development people at 9:05 on a Monday morning, I get a call from this fellow, perfectly on point. Here are the resources we're going to bring to bear from you. You will hear from my internal shortly, which occurred at 9:08. So there was a 3-minute lapse. The appointment was set up for that Wednesday with the institutional product specialist to provide an introduction to the strategy for both the institutional channel and the 40-Act channel. So this was right before the weekend, follow-up Monday morning, the call set up for Wednesday, absolutely informative. I said, I'd like to do a deeper dive on both of these strategies. In person would be best. He said, I'm in your neighborhood in 48 hours. How's that? I said, come on by. So this is moving on the fast track. They come in my office with all the materials, both in terms of process and attribution for these incarnations of the strategy. We review them completely. I said at the end of the meeting, the next step is I need to talk to the PM team. And the next week on Tuesday, we had a national call with various members of the PM team from around the country. We did a deep dive on the strategy. So as you can see, this is research concierge effort at its best. So we quickly moved into the operational side. I said, I need to know from your legal team certain issues related to the swaps and derivatives used in this strategy. And within 24 hours, I was getting back comprehensive analyses of this particular operational issue. So the research concierge work has moved from research to operations. Next thing we need to do is get some nitty-gritty paperwork done to understand if we can actually implement it on the custodial platforms we needed. And this was all done rapid fire, very professionally, on a total service concierge basis. So that's a good one. A bad one followed shortly thereafter. This was another strategy where we identified the niche, we identified the manager, we called the institutional rep, and he was a bit surprised to hear from me. And he said, well, thanks for calling. I said, well, I'm interested in talking to the manager. He said, well, you're a consultant. Do you like setting up your own calls, or would you like me to set up the call? I said, well, that's why I'm calling you. And perhaps you could do it more faster and more efficiently than I can. So they begrudgingly set up this call where we had already decided we wanted the strategy, and this was one of our manager candidates. And the call finally occurred a couple of weeks later. Instead of 2 days later, it's 2 weeks later. And the call began with an apology. They said, we're very sorry. We don't have a deck to explain the strategy. We couldn't get it through compliance. And I was thinking, well, you not only have you had 2 weeks, you've been working with this particular portfolio manager for a decade. I would assume that's enough time to get together the deck. So this whole process moved in a very slow and lumbering fashion, and it didn't actually reach the highest standards of being a research concierge. And in terms of the dangerous one you asked about, and I'm getting one of these every month now, we run a public fund of funds where our holdings are all 40 Act alternative funds. Everyone can see them. I now, once a month, get an analysis from an outside business development person as to what's going on in the portfolio. And this is, I'm a football fan. I'm actually a Patriots fan. Anyone here a Patriots fan? Anyone here don't like the Patriots? Okay, a lot of hands go up. Sometimes when I watch football, I'm thinking, Tom Brady would really benefit if I could just leap through that screen and tell him what to do. And so, just throw it to Gronk, even if he has a concussion and he's not in the stadium. Okay, just do that. So, being an armchair football advice provider is a bit dangerous. I also think it's dangerous if you start providing portfolio management ideas or suggestions to me. And one of the more interesting ones I got recently was a complete analysis of our portfolio on an unsolicited basis with instructions as to which managers to sell, which would then fund the purchase of the manager to buy, which the salesman was pitching me. And I think that's really dangerous. Because if you want to run into the surgical room and say, look, just give me the scalpel, I know how to do this, the surgeon might say, well, please don't. It's dangerous for my patient. Or if they decide your suggestion is good, they might use it. But I'm getting one of these every month where someone on the sales side is telling me how to do my job. And I assure you that can frequently be dangerous in terms of getting your story across. I've had enough of these that I'm actually open enough to listen, but it can be very dangerous. So that's the good, the bad, and the dangerous in terms of being a research concierge.
That's great. Sounds like a coffee book in the making. Joe, talk to us about, you do a number of different things, allocation models, you do the platforms. How does an investment manager get a new strategy on your radar to get into that research agenda flow?
Sure. Yeah, we have two primary, business channels: the institutional business channel, which is, qualified plans and endowments, foundations primarily, and then we have a financial intermediary platform also, which is really OCIO type business, as well as custom retainer type business for those intermediaries. And for investment managers to get onto our radar, whether it's new strategies, new teams, spin-outs, or existing client exposure type strategies, we funnel everything into one, this is an advertisement, one email address, which scales across our entire investment team. That email address is meetingrequest@Tiber-Kosmala, real simple. Anytime an investment team or professional is coming through Chicago, which is where we're located here, one email to that email address spans the entire investment team. We're all generalists, so we don't silo asset classes or public market, private market strategies. And the team reviews those daily. And if it is a strategy that is of interest, a team that's of interest, that analyst will grab that email, and we have an internal process to go ahead and calendar that meeting. So that's very clearly how we've got a pretty clear process to accommodate those managers and those strategies that we're interested in seeing on a regular basis.
So that brings up an interesting question. You mentioned kind of seeding or new strategies. Maureen, at Cambridge, you meet with many different types of clients, endowments, foundations. They tend to be a little bit more forward thinking or at the forefront of some of the investment decisions. How does an investment firm come to you or through a client an idea and talk about the idea of seeding if it's a brand new strategy, or maybe even more importantly, if it's a new vehicle? What is Cambridge's approach to looking at these new seating or even of a strategy or a vehicle?
Generally speaking, we're very interested in new ideas and new managers. Some of the best success we've had are with emerging managers. I'm going to take this a slightly different direction. One of the things that's really getting a lot of interest and traction amongst the private client side is this mission-related investing and ESG and social impact. And so really understanding what that means and talking to a lot of managers about how they approach that is a high priority for us. But generally speaking, there's a couple different ways. If I put myself in your shoes, you're looking at how do I get a meeting, and then what do I do in the meeting? There's a couple different ways to get a meeting. Like my colleague said here, we're allocated on the research side by asset class or asset categories, and happy to get you the name of the person who heads that group. It is hard to get a meeting. I will be honest with you. You have to have a pretty compelling story. Another way is if a client approaches us with an idea that they've heard about, and I think similar on the first panel, they talked about how clients might hear of another family office that is looking at something. A client might come to us and say, could you help us vet this idea out? Could you help us find a category of a slate of managers that we might be able to talk to about this particular idea? So without sounding obtuse or obscure, there is some nuance to this, and it's not just a clear cut, you call us up, I have a great idea, and you get a meeting. It is a little bit more challenging than that. But I'd be happy to talk to anybody about, their idea and their strategy. Courtesy of Dakota, I'm here, and, be happy to share any insights I can on a more, specific basis that you might have for your own personal objective.
I appreciate that, and I think that one of the other things when you get to like an Aon is regional specific, or the research teams in Canada or London or in Chicago. How do you interact with these various research teams when a manager comes to them, has a new idea, new strategy, maybe it's not approved, but you like it? What is your interaction with the research team to potentially drive that approval process if you think this is a great resource for a solution for a client?
Yeah, a lot of times the client mandate can drive new managers onto the platform. And a perfect example is recently we had a new client mandate and we didn't have an MLP manager that was 40 Act, which we needed. So that drove us to do a search. We actually opened up the search before we started calling people and did all of our traditional quant measures, et cetera. I mentioned dividend equity paying managers as well. That came up recently, prefers. Those are 3 areas that just came up in the last couple months that was driven by client mandates. So I get together with our research team. We talk about the managers at hand, who we have available and who we don't, who they've spoken with most recently. And if it's something completely new, not necessarily within my group, but in other parts of the firm, you're talking about regionalism, et cetera, and the different types of groups, like angel investing. So we wanted an angel bond fund, and we went to someone who didn't necessarily have that strategy, but we believe the manager had the right expertise to manage that, so we went to them to actually begin managing those assets for us. Mm-hmm. So it varies. So I think it's I think that hopefully that story is hopeful for you all, that new things are always coming along. And one of the reasons we may not use you right away, but if I take a meeting with you to get to understand your strategy, I may think of it 6 months down the road or even 12 months down the road and call you, which happened in these cases of the 3 different types of strategies I just spoke about. I ended up calling people I hadn't talked to in 3 or 4 years, mm-hmm. and then they had the opportunity to present.
That's great, thank you. We have about 15 minutes left. I'm going to switch gears a little bit. And Rick, we talked a little on the phone. Everybody's heard or is hearing a very consistent conversation at the consulting firms, driven by clients, driven by research, active versus passive. Obviously, not obviously to everybody. To me, I know that everybody in this room, including our panelists, are active management advocates. And Rick, with your alternatives focus, one of the other debate points that we hear or exploratory exercises is harvesting, where else can we seek beta, alternative sources of beta. We hear alternative beta, smart beta, multi-factor beta investing. I'm just curious what you're seeing from your purview on the alternative side in these funds, active, passives, but what are you seeing in the kind of alternative beta pieces?
Well, we're seeing the migration of all the lingo into alts. So we're seeing people create or talk about alternative strategies that are rules-based, but they might be called a smart beta incarnation or multi-factor long-short or alternative risk premia. And the lingo itself has a bit of magical connotation for the users. So applying the lingo seems to attract attention. But these are just different ways of implementing alternative strategies. And alternative strategies continue their migration, their democratization, if you will, their democratization of new sources of returns or risk management, where strategies that used to be available in LPs only became available in open-end mutual funds. Now they're becoming available in ETFs. So we're seeing that as the latest migration or the democratization of alternative strategies, which began 20 years ago with some regulatory and tax law changes. But it's marching forward, and a lot of these exclusive strategies will be available to a wider audience than ever before.
Excellent. Probably moving into 10 minutes, so the end-all be-all question that Chris O'Grady would string me up if I didn't pose out there would be, you all are talking to many different types of clients, and I think what's helpful is to get your take on any new, I won't call them trends, because certainly impact investing, sustainability, mission alignment, I know that's something Cambridge is very much focused on. I'd love for each of you to highlight some of the things that the firm is focused on, whether it could be impact ESG, minority-owned, women-owned firms, sustainability, and then through those topics, what are some of the kind of front burner searches that you might have going on in the next 6 to 18 months that kind of align to these things? You want to start?
So, again, we're a pretty large firm, and we span the spectrum on asset classes, so it's not as if we have one hot topic that we're in search of. So I think within each asset class there's some nuances, but generally speaking, the whole ESG momentum is very interesting to us. Minority-owned firms are interesting to us, but not at the exclusion of non-minority-owned firms.
Sure.
Not trying to be cheeky or anything. We do a lot in private investments. We do a lot in venture capital. We're very interested in disruptive technology and what's happening with disruptive technology and how that's impacting some of the companies that are incumbents in a particular market space. So it's a pretty broad brush. And it's not as if we have a search going on at this moment for, high dividend or preferred or anything like that. We've got the bases covered, but we're always looking for something that we might be missing, something new, something interesting.
Something that we talked about and something we hear frequently is expanding illiquidity buckets. Mm-hmm. Joe, is that something that some of your clients are talking to, whether it's private equity, private debt? What's happening in the kind of the illiquid space?
Yeah, I think that's been happening for quite some time. I mean, moving from public to private markets, allocations in that direction. That's been a decade plus, I think, migration. And I think I'd echo Maureen. I don't think the client base that we work with, which is on the institutional side, certainly more so in the E&F endowment foundation world, probably a noticeable trend, if we want to talk about trends, toward that ESG side of things, for sure. Particularly, interestingly, firearms, which is probably no real surprise, especially for those clients here in this city. But that is one thing that I'd say I'd label a trend that's been noticeable. But things that our firm, I'd say, not necessarily from a trend perspective, but a consistent perspective, we try to focus on our next cycle, and I think the last panel touched on a couple of those. couple of those things, what's out of favor, and why it may be coming back into favor. Maybe that might be value. That might be the next distressed cycle. Crowded asset classes and opportunities that those are going to present down the road. So next cycle focus is definitely where we try to train our eyes, for sure. Again, that's an always thing. The other always thing I'd say would be we aren't a huge firm. We only advise on $7 billion, so we're not a Cambridge by any stretch, which gives us a luxury of investing in very capacity-constrained strategies and funds in particular. That a lot of our bigger competitors have a harder time allocating a lot of the research resources towards. So I'd say those two things are probably two areas, sort of next cycle and a constant focus on real capacity-constrained strategies.
You have anything that you'd like to add to that, John?
Yeah, I would say ESG is a big point of research for us right now. Our investment committee's been debating the topic for quite a while and have produced a lot of research on it, and we should have a paper coming out in the next couple months. I think we'll finally get it finalized here. So that is on our minds, particularly with our ENF practice. We've seen a lot of interest in that particular space.
We hear a lot about ESG ratings for managers. I'm curious as to where is Aon at this point as far as how you've approached the ESG rating and how does that impact managers' ability to win assets at this point?
It's becoming part of our due diligence process, and that's why a lot of the research has taken a long time, because what are the more important factors and what do we want to focus on that could have more results? And a lot of it's been focused on the G part of ESG, on governance. We're very big on corporate governance, so we believe the managers we invest in should be big on corporate governance. So that's a very big part of it. And it is being developed into it because the two leaders, we have one in London and one here in the US who's working on the subject, and they're both manager researchers. So how do we not just talk about ESG and select ESG managers, but how do we actually incorporate that into our research process, and what questions should we be asking, et cetera. So you'll see part of that as part of Aon's offering as well going forward. The other areas of interest are alternatives. We still are big believers in alternatives. You can understand that because 3 out of the 5 major categories that we work with are alternative groups, meaning direct real estate, private equity, and liquid alts. So that remains a very important part of our beliefs and our research as well. And then finally, I would say the third pillar that we're really focused on is income. Retirement income specifically for individual investors and DC participants. I think now we're really seeing the DC participants that are starting to retire. What do we do with this money? So that's been a big part of our focus and research as well.
Great. Rick, and with you, and what's on your research focus?
Well, our research is fairly eclectic, but in terms of the area that I spearhead, which is fund-to-funds using registered alternatives, we are always on the lookout for new alternative strategies in 40 Act funds, and more recently we're on the lookout for alternative strategies in exchange-traded funds. Our interest is across all of those delivery vehicles, particularly on strategies independent of long-short equity or equity market neutral, because those are somewhat crowded areas, but we try to stay open-minded, so we're willing to look at those also. Alternative mutual funds, alternative ETFs.
Great. Appreciate all the insights, and hopefully some of this can spark some new ideas, but I guess we have about 5 minutes left. Maybe we'll open it up for some questions to the panel. Like Chris, I cannot see a thing, so. Any questions? Dave Hissey, any questions? No, I'm kidding.
If I could ask, many of you tier your research by categories. I know there's one set of generalists up there, but how do you manage the strategies or niches where they may cross across the traditional, for example, across public equities and the privates, or in particular catalytic niches? Choose your example, but how does your research process and how do you manage across those? Because you obviously seem to have an interest in alpha generation, and that often happens there. How do we navigate those waters with you?
Whoever wants to.
Yeah, I can take that one because I'm going through it with the preferred search right now. So both the equity and the fixed income team are looking at preferreds because we were debating which should it fall, and we decided let's have both teams look at it. That way we get the understanding, the full characteristics from both teams, and get the risks, the underlying risks well understood from both of those teams. So that's how we decided on that. And with the privates, it would be very similar. If there's a, it depends on, credit falls into liquid alternatives in some cases, but it could also fall with the fixed income team. So both teams may address a manager if there are characteristics of both within that strategy.
Thanks. I think that might be about it. So thank you very much, and encourage you to all follow up with our panelists with any questions, and have a great conference. Thank you.